Good morning, everybody. I am Marina Parkin of Koontz and Parkin CPAs, and I am joined here by my wonderful attorney extraordinaire, Jackie Durham, and Joanne Koontz is going to be jumping in a minute. Today is Tuesday, June 15th, and as always, our webinars are recorded and posted on our website and our YouTube channel. So if you find that this is a topic that you want to listen to again, if you didn't have enough fun the first time around, or if you think it'll be beneficial to some of your friends in a similar situation, definitely please share this information with them. Today, we're going to be talking about domicile and residency and the whole concept of coming to Florida and all of the different little topics that entails. We just wanted to sort of go overall in discussion of what it means and maybe discuss some of the confusion on the terminology of domicile and residency, and then give you some pointers on exactly how to establish your residency in the state of Florida or anywhere else that you move. And then maybe kind of go through some of the situations that we have seen with our clients. So we'll go a little bit on back and forth on our fun stories from the front lines, if you will. So obviously, let's, I guess, start by talking about why people are moving here. So of course, we've seen a huge influx in Florida in the last several years. So first, of course, it was the Trump tax law in 2018 that pushed a lot of the people that were already on the fence to start moving a little bit faster, mostly because of the limitation in the deduction of the income tax in their states that was imposed under the new Trump law. So people were not getting quite the benefit on the tax side of living in a different state and paying all those taxes and not being able to deduct them. So that was sort of a push, but it really affected people that were already in play, if you will, that were thinking about it, and maybe that made their decision a little bit faster. And then, of course, we fast forward a year or two, and then here comes the pandemic. And with Florida, we've been pretty lucky that it's been fairly open the whole entire time, and people can work from home. You can be outside by your pool and enjoy warm weather all year round and still work if your employer allows that. A lot of people also had sort of a lifestyle change, if you will, where they just said, well, you know, if I'm going to work like this, I might as well work from a house in Florida as opposed to being stuck in my townhome in Boston. So I heard that a lot from some of my clients, and a lot of clients said that they just wanted to be ready. They were ready to retire, and whether that pushed them into taking a little bit of an earlier retirement or whatnot, they were just ready, and that kind of gave them a push. So we're talking about really why you want to change your domicile. Of course, lifestyle changes, retirement. Florida has always been, retirement haven for a lot of folks. Family, if you want to move closer to be with your family who lives here, and then of course income tax savings. The other consideration too is possibly for those retirees who are still continuing to receive some of that deferred compensation or pension income by moving here to Florida, when they continue to receive that income, because that income is not really sourced in the state that they came from, they can definitely save a lot on the state income tax by continuing to receive some of that retirement income. So we'll talk a little bit about kind of sourcing of the income and where you earn it, but that's a huge consideration because a lot of that type of income you can avoid paying income tax in the state, even though that may have been originally earned in a different state. So estate tax savings are another consideration. Some states are better than others about, death tax, if you will, and how that's imposed. So these are sort of all the reasons for changing your domicile. So
and there's one more thing I want to mention.
Yeah, of course, Jackie, come on.
In addition to the state income savings, you also have to keep in mind that Florida has very attractive asset protection laws. So if you're thinking about the homestead creditor protection, There's also the tenancy by the entireties, the head of household exemption. All of these are really attractive. And if you already have a home in Florida and you're kind of just relocating and making this your new primary residence, or if you can really work from anywhere and you like the idea of, working in Florida where it's nice weather year round, and, you want to move out of Boston or wherever you're coming from, I feel like that's also a very attractive asset protection planning device. And, as long as you meet the criteria, which we'll go through in a little more detail in the webinar, you can enjoy that, even if you're still subject to some tax out of state. So I know, Marina, you can agree that depending on which state you still have some connection with, if you're spending part of the year in New York, even if you actually truly and legally establish your domicile in Florida, you might still be facing some income tax up in New York or Pennsylvania or Massachusetts. So it really is a state by state basis that you have to determine what your income tax will look like up in those states, because you may still be taxed as a non-resident. But some people, like you said, the pandemic, there's certain things that were teetering them over the edge. And I think when folks are educated on the benefits of the asset protection laws that we have in Florida, that ours are pretty superior to other states. So that's another reason.
Yeah, absolutely. That is, oh, we're joined by Joanne Koontz. Hello, Joanne.
Sorry, some connection.
Well, no worries. We actually just covered sort of the reasons why people want to move to Florida. So I didn't even give you a chance to jump in and say that you've been here a long time and you knew 20 years ago that you wanted to be here. And people are just now catching on.
Welcome to the newsflash. Although today's weather would not indicate that today's where you want to be. But no, I've been here 15 years and would not go back. Yes.
So we're kind of getting to my next sort of topic of discussion is really to touch on the difference between domicile and residence.
I think if you want to start from the beginning, because a lot of it got lost.
So essentially, one thing that I wanted to review was the comparison between domicile, residence, residency, and homestead. And while those issues are different, they're often frequently interchanged and confused by people. So you are able to establish your residency or your domicile in the state of Florida simply by filing a declaration of domicile, which is a free document to record with the county clerk's office. You can do that even if you just rent a property and don't own anything. However, you have to recognize too that the state of Florida, being absent of an income tax, doesn't really care if you are a Florida resident or not. So we welcome you with open arms. From a tax perspective, what's important is cutting off the tax in your home state. So while you can just say you're a Florida resident, that doesn't necessarily keep you from being taxed in the state that you left.
So what I wanted to also add here, Joanne, was that really what I see the concept is that when people talk about the residence and can I keep my residence in a different state? You can have multiple residences. You can have a home in different states, but you can really only have one domicile. And that I think is the key for people to understand. So if you use a home as your principal residence, for example, in a different state, you can still keep that home. That can continue to be your residence. That doesn't mean that it's going to be your domicile anymore if you're going to establish the domicile in Florida. So I think that is a key concept here, is to say, okay, where am I living versus where is it that I'm domiciled? I also wanted to touch on a little bit on that 183-day test, and that you're absolutely right, Joanne, is that it's really used mostly for the non-residents by the IRS to determine if they're residents of US versus non-residents. But different states still use the 6 months mark as one of the factors. It's not the end all and be all of sort of the factors that make you a resident of a different state, but it can be on a checklist, and we'll kind of go through some of the factors in a little bit, but it can be a sort of in their little toolbox of what are all of the things that you can used to determine where the person is going to be domiciled, i.e. a tax resident. So I think that is kind of the concept that makes it easier for me, especially not being an attorney and not using a lot of that sort of the homestead, which is very also specific by state. But I think if we look at the big picture and think about that you can have more than one residence, but only one domicile, I think that can really put things in perspective. Thoughts, Joanne, on that?
Completely. And again, back to what you're getting at with the states, you have to think that the state that you're leaving, if you are moving from, say, New York or high tax state, they're very interested in keeping their hand in your pot. So Florida's happy to welcome you with open arms because there's no downside to the state of Florida of accepting your residency. Like I said, the 183 days gets bantered around as though that's some real test when it really has to do more with foreigners who are being subject to U.S. tax as a tax resident. It really, you could be 3 months in Florida, 3 months in New York, 3 months in Colorado, and 3 months in Italy and still be a Florida resident. The test that you do see frequently referred to if you read about this is they look at not only your head where you sleep, but also your heart. So where are your things? I've seen cases in other states, and they're more aggressive in states that have a bigger deficit in their budget. So you'll see states like Michigan and Vermont and Connecticut, the Northeast kind of getting more aggressive because their budgets are tight and they want to hang on to people from a tax-based perspective. California's Franchise Tax Board also has a pretty good reputation for being pretty unreasonable. But those states are trying to hang on to you and say, hey, you still have a close connection here or a nexus here. So that activity that you're doing, maybe it's a business that you own or revenue that you're generating. Sometimes we see it with retiring executives and they are trying to leave that state and establish Florida residency first. If you're really moving, you move your stuff, you move your heart. So I've seen in audits where they've looked at where's the wife storing her wedding dress. You don't take your wedding dress.
Where's the dog?
You take it though if you are moving all your stuff. Now you're not required to sell the home in the state that you're leaving, but where are your relationships? Where do you see the doctor? Where's your hairstylist? Where's your lawyer, your accountant, your financial advisor? Where's the veterinarian? If you take Fluffy back to Ohio to see the vet, then that looks like your heart is still back where you left. We've created a list of items to check off. And I always tell people it's not exhaustive. It's not meant to be every single thing you should do, but it is a balancing test. So the more things that you have that weigh in favor of establishing your Florida residency, the stronger your claim is to cut off the tax arm of the state that you're trying to avoid. So, if you have a good relationship with your financial advisor for 35 years and you're reluctant to leave, okay, it's just another thing that's going to look like you're still there. You just want to make sure that you have more things that look like you're here. Same thing with churches and volunteer philanthropy organizations. It's not to say you can't support something back at home, but you should at least be also supporting things here. Now, for physicians, I feel like if people have a unique medical condition or something that's been treated by the same physician for some time, you don't want to upend relationships unnecessarily. So if you're getting treatment, you could continue to go there, but you just want to make sure that, again, you're mindful of the scale of the balances that really lead you towards looking like a Florida resident.
The key here is really establishing the intent. And which is why that list is not all exhaustive, and you can have some of the other factors and they can be very specific to your situation. But the key here is intent, and to use these factors to support your intent to be a resident in one or the other state. Now, also let me say this, that the burden of proof is on you to prove that you are going to be domiciled in this state or another. So the state that you're leaving that is still chasing you for income tax can easily come at you, and they're not going to be the ones chasing where your driver's license is. They're just going to slap you with a audit or a notice to say that this is what you owe us for the income tax that we think you owe. And then it's going to be up to you to prove your intent as to why you think that you've created enough factors to establish your Florida domicile.
And Marina, wouldn't you agree that there's plenty of folks that move down here, they go and they follow the statutory factors that you're referring to under law. And they really do a sufficient job of establishing their domicile in Florida, yet they haven't cut ties in their former state. They haven't canceled their status as a resident there. And so they continue to get these tax bills because Illinois is saying, I haven't heard from you. I assumed
I didn't know you left.
Your home is still here. You still have a driver's license here. So I think it's equally as important to cut those ties. And I feel like some of our clients have run into that.
This is absolutely the case. And I was just reading the other day on the whole residency and domicile issue. And you know, people are saying, well, when should I cut ties with my state? And when should I cut ties first, or should I establish myself in Florida and then cut ties? The answer is both. You have to get both, which is my favorite answer to everything.
Of course, the answer is both. It's Marina.
You have to do both. And the more you can do those things at the same time, the better off you are to establish that not only did I open a bank account in Florida, I actually closed the bank account in the state around the same time. The other thing on the timing that I want to say that I also read, and I hadn't paid attention to this before, but on my end, we file a sort of a part-year resident tax returns when the person moves, so they may, you know, be earning income in a different state and then moving to Florida or moving to a different state. So we always do the part-year return. I just read something very interesting to say that if you pick January 1st or December 31st, that does not look good. That is a high risk of audit because the chances are of you moving on December 31st are slim to none because everything is closed. The moving companies are not working, and it's just, you know, none of the things are open. And so, no, you did not. You may have moved December 22nd, or you moved December 27th or January 3rd. But if you pick, which is always a clean way, it's always easier when we file a tax return to say, oh, well, it's December 31st, because then we subject this to tax, and then starting next year, we don't. But in reality, when you're looking, especially if you're coming from a state that's going to be chasing you that you already know because your income sort of calls for it, we want to pick a real date when we think that you have created enough of these factors to consider yourself now domiciled in Florida. They don't all have to be done by that date. You didn't have to cut all of the ties, but pick a day where you can reasonably say, okay, it doesn't, again, have to be on the 6th of the month. It can be on the 1st or 31st, but maybe let's not pick January and December. So that is one important thing that I wanted to highlight today, because that was brought to my attention and I was a little bit surprised, but it totally does make sense.
Yeah.
It's no different than when every single expense on your tax return ends in zero. Like this was $500, that was $700. This, you know, like, do you ever go to Publix and it's just $50? No, it's $48.13 or it's $53.29. Like maybe a couple times in your life it'll be $50 even, but not every line item on the tax return. And that's the, that's like the round number of dates is December 31st.
And if it is, you should go play the lottery.
Yeah. That's exactly right. That's exactly right. So Joanne, from your standpoint, then when you see people coming here and you do the closing for their home, what do you advise them as sort of the first step to do? How do you declare yourself as domiciled in Florida?
So the declaration of domicile document that you can record is a good start. The problem is people want to do that if they know about it and get a driving license and register to vote and they think they're done. That's the beginning, not the end, just like everything else that we talk about. If it was that easy, there wouldn't be volumes of cases about it. But you know, you need to start working on also the setup and of the relationships. So banking relationships. It's not just call Chase Bank and change your address to the Florida address. That bank account was still opened back in Ohio or Michigan or Illinois. And so it's still an Illinois bank account. So I would recommend closing that and opening a new one you can stay at Chase or whatever bank you're at a new institution in Florida. People hate that mostly because everything is on auto pay and Amazon's already linked to it. And you have no idea how much stuff you've linked until you change it. So it is inconvenient. It's probably the thing people complain about the most, but it has a big impact. So it's something that I do like to see done on the quicker end of things. It shows that severing of the tie with that prior state. Keep in mind too, though, if you have rental real estate in that state, if you have rental property in that state, that's going to continue to be taxed, but we want to get the rest of your income out of that state.
Absolutely. And also kind of in reading a little bit more about this, you know, filing that I'm kind of back a little bit to filing that non-resident or change of residency tax return is yet another factor to support that you are now resident. So I took the position and pick a date that I moved and pick a date that I'm domiciled here and filed that non-resident return. It is definitely a little bit harder to cut or sever ties if you do continue to have property. But again, if you've got enough factors where you've cut enough ties and really all you have left is your home, which, you know, now becomes your vacation home, then you can definitely consider that you fulfill your intent and show that you've created new residency. It is a little bit easier if you actually do sell the home that was your principal residence home and maybe you want to downsize and buy a vacation property. It's definitely a lot harder if you continue to own that home, because remember, just like in Florida, when you file for homestead, you were likely homesteaded in that home up north. So the county, it's not just the state. Now you've got the county, you've got the city issues. They may still have you on record as, you know, this was your homestead, right, in a different state. So now when you're talking about severing ties, did you remember to notify the county there that that is no longer your homestead, or however it is done up north? So sometimes, again, not to say that you have to sell the property, but sometimes it's yet another check mark on your list that if you are planning on selling it, go ahead and do that so that you can really have a clean cut, a lot cleaner cut.
Yeah, and one other thing I want to mention is, I know that the 183-day rule is not like some hard and fast rule in the States, but there are a lot of other states within the United States that do follow a similar rule. Like maybe it's 185 days, not 183, whatever. But what you need to keep in mind is if you say move from New York to Florida, you're attempting to domicile yourself in Florida, but you still have to spend some time in New York for work. You need to make sure that you're not breaching their threshold as to what establishes you as a New York resident, because that could also counteract your domicile efforts here in Florida. And another thing that I've recently heard about as well is that you need to consider the size of your respective homes. So if you're coming and you're trying to domicile yourself in Florida, but you have some Mac Daddy home up in Illinois and your Florida home is more modest, that's just another factor that could be weighed against you and making it seem like, oh, you're trying to, yes, establish a domicile, but this is not really your home. So just raising my hand.
That is a great point. It is a lot of those little factors that we don't think about. The other thing is, Jackie, you hit the nail on the head a little bit, and I want to get a little bit more into the business and work, and we'll get to that in a minute. But the one thing is, when they say, you know, move your heart, not just your head. If you move here from New York, and then so you move in the middle of the year, and then you continue to go back because there's a wedding and there's a family event, and then there's grandkids that are out for the summer, and you really end up being in New York most of the year because your family is still there, your pets are still there, you're still a member of the club that you're a treasurer on the board of, and doing all of those things. Just because you bought the home in Florida, by the amount of things that you're still doing there in terms of the lifestyle and the people that you're spending time with, are all those things are going to count against you. So you end up most of the time in a different state. So that is definitely, you know, and the more we read, and I kind of read, a lot of the cases are different states. So some of the states may use them as precedent or as different factors, but there's multiple cases in multiple states. And so from each case, you kind of learn a little bit of different thing. What I wanted to discuss here, which is what the questions we get a lot from our business people, is what happens when you are still active in your business and you want to move your business here. So maybe let's talk a little bit about that. Do I have to move my company? Do I have to close my company, open a new LLC here? If I have a contractor's license, we have a client right now who her husband is a general contractor, and he continued to have a license I believe they're from Illinois, and open a new entity with the same name, but in the state of Florida, and then he got the license here. So now they're sort of filing in 2 states. We're trying to close the company here, get the new company here going. IRS doesn't care because federally you have all these entities, but on the state level, the issue is, where do they file what? And also, how does that impact their residency, and then what happens really to the business? Can we move the business? Should we close and open the business? So can we touch on some of those factors on from the legal standpoint, Jackie?
Well, what I would say is, if it sounds like this particular client still has their business in Illinois active with an active contractor's license tied to it, if they're no longer performing services in that state, I would go ahead and terminate those. Something else that a person moving from out of state can do is, if you want to avoid having to file for a new EIN, create a whole new entity, you can convert from your state, your original state, to the new state, to Florida. There are very particular steps that are involved in that. And a lot of times people think that they can just file a conversion in Florida and they're done. And that's absolutely not the case. You're going to need to consult with an attorney in the original state of the entity's formation to make sure that you're properly converting from Illinois to Florida. But what I would say is, unless your particular client, Marina, is still performing to some extent contracting services up in Illinois, there's no point in keeping that open. That is another just chink in the armor, if you will, for establishing the domicile here in Florida.
Absolutely. And if you are a contractor or a hairstylist or a lawyer or anything that requires a license, you're going to see that license transfer at around the same time that you're moving, unless that person is at a transition in their life. Maybe they're retiring, or they're getting out of the practice and into some other kind of, consultancy or something like that. So that'd be something else that we'd want to see lining up along those same.
Joanne, where do you go in Florida to establish a license?
Well, it depends on what license you've got. So most licenses are handled through the Department of Business and Professional Regulation, and they license everything from contractors to hairstylists to CPAs. However, the lawyers, for example, were licensed under the Florida Bar, and so different aspects of different licensure. Like if you're in the medical field, there's not just the medical licensing, but there's ACA and other agencies that you need to get licensing with. So that's a difficult one to say from a blanket perspective, but for the most part, the general licensing is handled through the DBPR. You also will hear that there's a local occupational license or local business tax license that are handled through the counties. Those really don't have anything to do with your credentialing to perform the service, and it's more a fee to be able to offer the business in that location. But those are things to consider as well.
Excellent. What if your business continues to operate in the other state, and you're sort of opening an affiliate, if you will, or you're just expanding? What happens to you? Not necessarily even how you do it, but how do you then support your claim to domicile in Florida?
Like, you gotta have some really good middle managers. So you've got to get your hands off and get your head up so that you're overseeing the business from afar. The example I like to use for people when we start talking about this is look at Google. If you're a shareholder in Google, you're watching the earnings, you get some dividends, but you don't really have any decision-making authority. You don't have power. You want to look more like that if you don't want to be taxed in that home state. If you are still on every Zoom and running every call, running away to Florida and jumping on Zoom is still an integral manner of running the business. And is it impossible to overcome? No. If you're really strong other factors everywhere else, then maybe you're fine. But it'd be nice to see a transition or a handoff to the next layer manager or to your successor who is actually running the business. And maybe you're providing some guidance and oversight and continuity. But the daily reports aren't coming to you. Otherwise, the home state is going to argue that you still have adequate nexus. They may be wrong. I mean, a lot of these claims are overreaching. That's why there's so many lawsuits about it. But it's certainly an easy target to pick, and a lot of people don't fight about it. So that's just an easy way to be sure, is that if we can see that handoff of power, where you're starting to step back, even if it's gradual, but it needs to happen and not just be you decided to work remote. And because you've got an ownership interest. If you were just a worker, yes, but if you've got that ownership interest, that's what I'm talking about.
And when do you say that, like, let's say again, I'm moving from Illinois, I still have some business going on in Illinois, so I want to establish domicile in Florida. So I'm going through my checklist and I convert my entity to be a Florida entity, but it's a Florida entity that is still transacting business in Illinois. I think that would be a good way to make sure you're still like chipping away at the domicile checklist. But at the same time, I feel like I've been noticing that certain of the Northeastern states, like you said, are very aggressive when it comes to that income tax. And you can still be a Florida domiciled resident, but pay income tax as a non-resident in another state. And I think in certain states, especially like New York, I've been hearing things about the convenience versus necessity test that they have, where if you are by your pool working in Florida at your convenience for a New York company, all of that income may still be subject to New York income tax.
And keep in mind, after COVID, when so many more people are working from home, where there is a lack of clarity, we expect clarity to be issued, new legislation to come to say, hey, the nexus test still applies at Zoom. And right now the statutes don't contemplate that stuff. But these states that are seeing big fleeing right now to avoid the tax, they're gonna start having to do something, because the people are leaving in droves, and they are not going to be able to lose that tax. Is it constitutional or not is going to be another argument, but for someone who's more of a scholar in that area than me, but I see
that quite a bit. I see that quite a bit because where I think it kind of begins too is with the employer. A lot of the clients that I see continue to work for the same employer, but the employer is able to say, well, this is my employee in a different state. And then maybe they don't, on their W-2, they don't necessarily indicate that now they're a New York employee. They can be a Florida employee if that person says, I am now a Florida resident. What happens though on the employer side is you got to be careful that you didn't establish a nexus in a different state. So if you're a New York company and then you've got employee moving to California because now they want to be by the beach, no, I don't know that a lot of people are moving there, but let's say you are now all of a sudden you've got, as the business, a presence in California because now you have employees there. And depending on the factors that are used to allocate the income to pay the tax, you may have completely shot yourself in the foot there. We, of course, being in Florida, see a lot more of that on, hey, if I've got a New York employee that is now Florida resident, I am not going to issue them a New York W-2 or indicate that those wages were. I think that's kind of the first level of support. When we see these documents, we say, okay, that looks good. We now, when we file your tax return in New York, because now your employer has indicated you don't have New York wages, we kind of go with that. But I think you've got the state of New York who may be coming after both the employer, right, and the employee to say, hey, wait a minute, you're right, now it's leaking all of this state income tax that you withheld. Is this person really a Florida resident? And are you, the employer, doing the right thing by making a note of them as a Florida resident? And are they really, and now do you have a problem yourself and the employee as well? So that's an issue where I still see a lot of gray area. I don't think we really know the answer here on exactly what to do. I've got a client right now that is trying to fight with the state of New Jersey because they left. And of course, the employer still put them as New Jersey for the full entire year on their W-2, but he kind of wants to argue that he was a Florida resident. So we'll see how that goes, because that's gonna take place. But I guess all of those things are a little bit new, and there is no precedent. So the employment issue, I think, is definitely a big issue right now with COVID and where people work. And Jackie, you hit the nail on the head. Becomes the necessity of the employer versus the convenience. And you're kind of saying, if essentially the employer is based in a certain state and you otherwise normally would be working there, that's where your wages are considered to be earned and taxed. So that's definitely the one other topic I kind of wanted to get to, which is, we get that question quite a bit, is husband and wife. Let's talk about that.
You don't have to live with them, but you do have to live with them.
The wife and the dog are in Illinois, and I'm in Florida.
Yeah. I moved my dog, but not my husband. What do I do?
Genius.
Do I have to move both?
No, this is the not both. No, we do hear that a lot, and it's really tough to see that separation and have that be a really logical argument. Now, we know plenty of folks who are in military situations and others where the spouses legitimately do not live together, but you got to claim one. If you're filing a married filing joint return, there's only one address line. And especially when you start getting into hairy things like homestead, which I'll talk about in just a second, but that residency, you all are together. It's part of being married.
Yeah. You got to pick one.
If you can pull it off, though.
Well, because here's the thing, even if you end up establishing your domicile in Florida and one of you still works in a different state, and let's say you jump through all the hoops and you are considered a Florida resident for your employer purpose, but if they still issue you a W-2 that has some state income tax, you're still going to end up paying state income tax. You're not, because the rule is going to be that employer is in New York, and for the convenience of the employer, you would normally be in New York. So those are still New York wages. So even if you're going to jump around and try and establish yourself a Florida resident, just doing that, you may not be able to just get out of that state income tax, because that's governed by that rule. So by leaving the spouse here and doing that, I don't think that's going to help you on the tax of your earnings.
And honestly, lots of times when I get that question from people, it's the high income earner spouse that's staying in the high tax state, and they're trying to move the not employed spouse to Florida, and it wouldn't help anyways, even if that was legitimate. I've never seen that the busy person is moving to Florida and the unemployed person is staying. It's not typically how life.
Yeah, that's exactly it. There's really, if you've got that spouse living in Florida that is not earning income, you really are not any further ahead. That may be your number one step in starting to, maybe you send the spouse down there to shop for homes. And once that happens, and then you start knocking out all of the other factors, then I think you've got it. But generally speaking, I just don't think that works. It's
a big feat to try to overcome, for sure. So it's not one I recommend. It also can be disruptive from a homestead standpoint, and you might as well put the light on and ask for an audit. So at some point you got to just weigh the factors and the risk and see if it's worth it to go down that road. But for the most part, when people inquire about it, they're trying to get set up and they're trying to get homestead in Florida before they're really done working up north. That's probably the most common area where I see it. It's like, hey, I can go ahead and send one person first, but I've got to wrap up my business, and that's still tough from claiming homestead standpoint.
So what happens then, Joanne, with the actual homestead? Because again, it's a little different than the actual domicile. Especially, and then you've got the income tax situation where, do I still have my 2 years of when this property is used as a house and stuff like that?
So keep in mind that homestead is a Florida thing, and the IRS knows nothing about it. So when we talk about the 121 gain exclusion that you're referencing, the gain on the last 2 out of the 5 years, if the property was your primary residence, not your homestead, but your primary principal residence under the IRS test, of course, it's IRS. Principal residence isn't even necessarily the place you live right now.
Right.
You could have
Yeah.
moved out 2 years ago and it's still your principal residence. So not the case with Florida. Florida homestead is the home where you live as your primary residence and as your domicile in Florida. That gives you two benefits. It gives you a constitutional homestead protection against creditors making a claim against the property without your consent, without a mortgage, without signing a lien. It also gives you the tax protection where you get $50,000 off the tax assessed value of the property, and you get to participate in the 3% Save Our Homes cap. So there's a maximum increase on the tax bill of homestead property that can only increase 3% per year. The difference of what the actual increase was from a fair market value increase per the county property appraiser, less the 3%, that delta kind of goes into a bucket of savings, which you can take with you. That's called portability. So when you sell this homestead and move to another, you can take that with you. This is really where people get into a lot of trouble when they're trying to cut off their residency back home. Like Marina alluded to earlier, they forget to call Illinois and say, oh, P.S., the Mac Daddy home in Chicago is no longer my primary residence, because it doesn't really show up in your face anywhere. So it's definitely something that people overlook. Then you come to Homestead in Florida, they say, hey, do you have property anywhere else? You say, yes, I have still the old house in Chicago. And they go, oh, well, you can't homestead because that's still homesteaded. So worse is we've had people who've gotten married to somebody who had homestead property up north, and then they throw them on the deed because they're married now, and nobody got alerted to it was already homesteaded. So the prior state doesn't get alerted, and Florida doesn't do the search the same way when you just add the person, and that's oftentimes how that becomes an improper homesteading, and then you get a big tax bill from the Florida property appraiser, and people go, oh, this is unfair. Well, you know, stop doing quitclaim deeds without talking to people. Not the point of today's topic, but a webinar all in and of itself with so many issues there. But so anyways, that's something to keep in mind, is that homesteading really is Florida giving you protection from creditors and in that homestead, which is the most generous homestead in the country. But keep in mind that also, just because something is your homestead doesn't mean that you don't have tax residency in another state. So you can be homesteaded here and fly to New York twice a month for business meetings, never lived in New York, never want to live in New York, and still end up a tax resident of New York because you're there enough to be taxed. So just got to be careful about that. How do you change your homestead in a prior state? You contact the county. Some have a form, some just ask you to write a letter, and they will give you confirmation that homestead has been revoked. And the county in Florida where you're homesteading will want that letter as well to show that that's, unless their tax records update in the meantime. But typically I just tell people, get the letter confirming that you've revoked your homestead in the prior state, and because they're usually not a big financial incentive for them up north anyways. So they don't give the protections that we give. So you certainly don't want to be stuck with that homestead and not ours.
Well, and also prepare yourself, because just like in Florida and a lot of these other states that have homestead tax exemptions and caps and things like that, if you're going to keep the house in Illinois and domicile yourself in Florida, when you revoke the homestead tax benefits in your original state, the next year there will likely be a reassessment of your property, and it's going to go up to the now current property. If you've held that property for the last 20 years or so, it's going to be a pretty big jump. And sometimes there's some sticker shock there. So just prepare yourself for that.
Yeah, especially if it's a property that's in a great neighborhood and you've had it for, 20 years. And yeah, absolutely. Yeah. Some of the other questions too, I wanted to take a peek at some of the questions. Is there a form to file to change your tax residency in each state? Well, we can speak for Florida that there is that declaration of domicile form to file in the state of Florida. I am sure that different states have something similar, and you may, just look in the kind of in each state's, whether it's a website or kind of a Department of Revenue site or whatever the case may be. But I think that's definitely a state by state. Joanne, have you come across any from different state that you can sort of give some advice to, or they're sort of similar? And
they're really on a county basis in my experience. That the homestead's not really granted by the state. It's typically more of a county. Some have a city tax as well, like a city real estate tax, but for the most part, as a general rule, that's going to be a county issue. If you're concerned about how to make sure that that's cleared, I would call the county that property is in and talk to them, because they all have different procedures. Some of them have a specific form, some take just a blank form letter.
A really good question, which we see quite a bit. What happens if you rent your house out in the prior state and then you buy and live in Florida? That is a fantastic question, because what happens is now you can be a Florida resident for tax purposes, but what you still have to do is continue filing as a non-resident in the state and declare your rental income. And now you're able to claim rental expenses against it. So this way you can still probably, with the rental expenses, you know, in my experience on the residential rental property, you're not going to have much of the income tax unless it's some amazing vacation home, which you're just, you know, banking in. But for the most part, if you rent your residence, now it's a rental property, and now you, with all the expenses, you likely end up with very little income, but you still continue to file, except now you're filing as a non-resident, only showing rental income and expenses in that state as the source of income. And again, you got to be careful when you think about the source of income, which is the other kind of final issue I wanted to touch on, is that, you know, rental, it's easy to say it's sourced in the state because the real estate is actually physically in that particular state. So you want to kind of look at some of those deferred compensation, which that's where the states are chasing you, because it's sourced in that state as far as you working there before to earn it. Yet now when it's paid out, it really doesn't matter where you're a resident. So a lot of that deferred comp can be received when you are already a non-resident of a certain state, same as pension income. You know, if you're getting pension from the state of Ohio, once you're a Florida resident, that pension is no longer considered earned in Ohio when it's paid out to you today. You've already paid your taxes in Ohio when you earned your salary, which, you know, was contributing to you earning that pension. So we never really see any issues. The only thing you, again, have to make sure you do is notify all those payors that you have moved, so that when they do issue you those 1099-Rs to show your pension or deferred comp or whatever the case may be, they are reporting it to you as a Florida resident. So, and most of them do. There's really never an issue there. Any other experience in that area, Joanne? I know we get really, the W-2 is an issue, but those 1099-Rs for pension income are fine. Typically they're clean. If you did your timing, if the timing is right and you notified everybody on time.
One thing I do see is a question in the chat bar that says, how do you let the prior state know you moved to Florida? You're going to file a part your resident return that's going to indicate the date that you left that state. So that's how they know to expect that you've disappeared. And then also, is there a form to file to change your tax residency? Tax residency is really up to you to demonstrate, and the only way, you can't say, hey, look, I've moved in the middle of the year to the tax authority. You're doing that on the tax return. So keep that in mind. When I was talking about the bank accounts earlier, just in summary, because now I'm looking at the chat bar, I was using Chase as an example. It doesn't matter what bank you're with, whether they're a huge multinational bank or a local credit union. I still recommend closing that existing bank account in the state that you're leaving and opening one in your new location. It really doesn't matter which bank institution you're with. So.
The question is on, can we assist with the filing of the domicile? Is that something that we can help, Joanne, on the K&A side? Okay.
Yeah, we can help with that. And also we can help with determining the timing and really doing this strategically. This wasn't something that I planned to have in our practice area. It kind of came to us. We had a retiring executive from a Fortune 100 company who said, hey, I'm going to retire. I'm going to trigger a huge deferred compensation payment. And I want to establish my Florida residency first. So we did a ton of research and just kind of kept up with it and kept growing on it. And it's kind of turned into a thing that we do. It wasn't part of the plan initially, but it really, with everybody moving and with doing real estate and corporate and tax, it really dovetails nicely because the people are moving, the business is moving. And they need a house, so we can kind of service all of that, all of those questions in one, and also having it, of course, be attorneys and CPAs in the same spot, makes it real easy to do that. So.
Well, and that, just like you said with the business, we can't blanketly answer, is it better to move your business or close and open? It's really going to have to depend on the circumstance. So that's the other reason to come and chat with us, and so we can kind of gather the facts and come up with the best advice on how to easier do this, so you can keep running and working here.
Sure. Beautiful. Well, this was fantastic as always. You guys are amazing.
You are amazing.
And to have the trifecta to boot is never a bad idea. As you know by now, all of these webinars are recorded and distributed so that you can replay them. Jason's going to have fun editing this one to get it ready to go, but thanks for your patience during our technical glitches. We will be back next week with John Cipher to work on the second part of hiring and how to find candidates. If you have topics that you'd like to hear about, we welcome your input and ask that you do email us and let us know what you'd like to hear about. We also are interested in your questions. So many of you provided questions before today's webinar, and we appreciate that because we're able to address those things. Once the webinar link once the recording has been uploaded to our YouTube channel, to our Facebook page, and to our websites, you'll get an email as an attendee, and also you can always check our website for those postings once they're up. And if you have questions, we look forward to helping you. Thanks so much for your attention. Have a great day, guys.
Thank you.
Bye.